Good afternoon, everyone. This is Chuck Self, Chief Investment Officer for iSectors. I'd like to thank you for joining us today to review the iSectors second quarter 2017 performance update. I will be providing a brief second quarter performance overview of all the iSectors models and could conclude with a research brief on the markets. This call should last about 10 minutes with questions and answers to follow. Please feel free to ask questions anytime during or after the presentation by clicking on the chat box in the lower right-hand corner of your screen. This presentation will be recorded, and a copy will be available on our website tomorrow at www.isectors.com. Just click on the iSectors blog icon, and it will take you to a link to access the recording. We will also be sending a link to access a recorded copy of this presentation to all webinar attendees immediately after this call. Although Post-MPT growth underperformed its benchmark in the second quarter, Post-MPT moderate bested its 60% stock, 40% bond benchmark. Both Post-MPT allocations were negatively impacted by energy holdings. These strategies were helped by technology and financial stock allocations. Technology, led by mega-cap stocks, has been a leading sector. As presented in the chart on slide 3, sectors such as technology, represented by the Fidelity Technology Sector Fund, FTEC, and financials continue to move positively in response to growing demand and hope for more favorable regulation and tax policy. Energy, as represented by the Vanguard Energy Sector ETF, or VDE, did not fare so well. By the end of the quarter, Post-MPT growth had added to its financial overweighting. In Post-MPT growth, over 80% of the allocation is invested in financial, technology, and utility stocks. Post-MPT moderate is more conservative, with strong allocations to treasury bonds, but also an overweight in technology. The iSectors Post-MPT allocations continue to outpace other ETF strategies. We are pleased that growth is ranked first among all 25 global allocation ETF strategies for 10-year performance in the Morningstar ETF Managed Portfolio Database. Investment advisors will be wise to consider Post-MPT growth and moderate allocations as core components for clients' portfolios. The global allocations turned in mixed results for the quarter. Domestic equities underperformed global equities, and they both fell behind the Standard & Poor's 500. Both equity allocations benefited from growth holdings, while high dividend funds detracted from performance. The global fixed income allocation was positively impacted by international corporate weightings in the quarter. The allocation was hurt by short-term U.S. holdings. The iSectors domestic equity allocation has earned very attractive returns over the past 5 years compared to most large-cap blend strategies. In fact, the domestic equity allocation is ranked 10th out of all 699 ETF strategies in the Morningstar database for 5-year performance. The pairing of iSectors Post-MPT growth and domestic or global equity has been a very powerful core equity combination historically. As we discussed in previous quarters' webinars, iSectors is pleased to announce our 15th strategy, the domestic fixed income allocation. As interest rates begin to rise, advisors and their clients need a strategy that attempts to minimize realized losses, earn attractive yields, while providing complete liquidity. The domestic fixed income allocation was created to meet these goals. As you see on slide 5, the portfolio consists of approximately 55% investment-grade corporate bonds and 45% high-yield corporate bonds, spread over 2,800 plus issues. The allocation owns these bonds through defined maturity exchange-traded funds laddered from 1 to 5 years of maturity. These funds hold a diversified group of bonds, all maturing in the same year. Monthly, interest earned in the funds is paid to the shareholders. On December 31 of the maturity year, the ETF is extinguished and the undistributed principal and interest proceeds are released to investors. Since there's no trading in the funds and all the bonds mature before the ETF is extinguished, realized losses are minimized. With a current yield of 2.9%, you may wish to make this allocation a core holding in client fixed income portfolios. The endowment and liquid alternative strategies underperformed their benchmarks in the quarter. As indicated by the black line representing the Wisdom Tree Dynamic Long-Short U.S. Equity Fund, or DYLS, alternative equity funds were strong performers in both allocations. The endowment allocation also benefited from its international stock and bond holdings. You will also see from the red line representing one of the Energy Master Limited Partnerships funds, MLPA, that commodity positions in these funds held back returns. Both allocations are broadly diversified and are aimed to reducing total risk in client portfolios. Also, it should be noted that the liquid alternatives allocation has outperformed hedge funds over the past 5 years. Given the advantages of the allocation, including daily liquidity, complete transparency, availability to all clients, not just accredited ones, and a current yield of 2.6%, liquid alternatives will provide attractive risk-return characteristics when equity returns ease. The inflation protection and precious metals allocations declined during the quarter. As indicated in the chart on slide 7, real estate, as represented by the Guggenheim MSCI Global Timber ETF, or CUT, helped inflation protection's results. Energy and broad commodity funds negatively impacted the inflation protection allocation, while silver bullion hurt precious metals the most. We continue to believe that a 10% to 20% allocation to precious metals, inflation protection, or liquid alternatives will be worthwhile given our view that the next 5 years in the equity market will not be as profitable as the last 5 years. The tactical global balance allocation underperformed its 60% stock, 40% bond benchmark in the second quarter. As represented by the red line shown in the chart on slide 8, broad commodity funds like the Elements Rogers International Commodity Fund, or RJI, were the leading underperformers for the allocation in the quarter, along with gold stocks. International equities, as graphed in black using the price movement of the Vanguard FTSE Developed Market Funds, or VEA, enhanced returns in addition to emerging market stocks. The strategy has become fully invested in all global asset classes except for commodities. Finally, the chart on slide 9 indicates that capital preservation has earned almost 2.7% on an annualized basis over its 7+ year life during a time of low interest rates. The yield is attractive with a short duration while maintaining investment-grade quality on average. Capital preservation rose during the quarter due to corporate and high-yield holdings. As we discussed earlier, dividend funds have had trouble keeping up with growth funds so far this year, given strong technology and healthcare results. iSectors continues to believe that advisors should have a portion of their core equity positions in dividend stocks. In all of our strategic holdings, we have optimized the equity portfolios to include an overweight in high dividend and dividend grower funds. The charts on slide 10 present the case for this allocation. The top left chart provides the quarterly 12-month outperformance of high dividend stocks compared to growth stocks since 1990. Although there are significant periods of underperformance, including much of the 1990s, and over the past few years, high dividend stocks have provided protection in negative markets when clients need it the most. This includes the 1991 to 2000 and the 2007 to 2009 periods. The bottom right chart shows the annual outperformance for growing dividend stocks compared to growth stocks in the same time frame. Dividend growers have had better results in most periods. But by comparing both charts, you will notice high dividend stocks outperformed dividend growing stocks in bear markets. Also, there are times when both dividend groups underperform growth stocks. The inclusion of high dividend, dividend growing, and growth stocks in our allocations has led to the strong results posted for domestic equity and other iSectors equity strategies. As you carefully inspect the disclosure page, we will now begin the Q&A portion of the webinar. If you have any questions, please type them in the chat box in the lower right-hand corner of your screen. Our first question has to do with the fixed income portfolios. And the question is, why have short-term U.S. bonds struggled? Well, as you know, the Federal Reserve has been increasing interest rates, the Fed fund interest rates, over the past couple of years, and certainly in the past year, they've increased the short-term interest rates 3 times. In that process, the short-term bonds that are the most exposed to short-term interest rates have had a hard time keeping up. The intermediate part of the curve, let's say the 5 to 10 year part and the 30-year part of the curve, have actually done quite well, and because the Fed doesn't have as much influence on those part of the curve. And at the same time, we've been in a time of low economic growth and relatively slow inflation. So we have seen the yield curve flatten from the short end, meaning that short rates have become closer to long rates. And when rates go up, prices go down, and short-term bonds have underperformed longer-term bonds. Are there any other questions? Seeing none, I want to conclude by thanking you for attending our webinar this afternoon. If there's anything that we could do to assist you with your wealth management or 401k asset allocation needs, please let us know. We can be reached directly at 800-869-5184. Again, thank you, and we hope you have a great rest of the summer.